He has the vault, he has the weight, 280 pounds of pure silver, locked away where no bank and no government can reach it. By every measure he's been told to trust, he is safe. But there is a question no one in this community wants to ask. What happens the day he actually needs to spend it? Not someday, not in theory. The day the grid freezes and the silver in his hand is suddenly worth nothing at all. Welcome back to Currency Arc Insight, the channel dedicated to decoding the forces shaping gold, silver, and the future of monetary stability. Each week, this channel examines the strategies, warnings, and blind spots that serious wealth-conscious investors cannot afford to ignore. Today's investigation looks past the comforting image of the silver stack and into a question few analysts are willing to confront directly: what physical metal is actually worth when the system that prices it stops functioning normally? There is a particular kind of confidence that comes from opening a safe and seeing 280 pounds of pure silver staring back. For many investors, that weight represents more than metal. It represents independence from a financial system they no longer trust, a hedge against currency debasement, and a quiet insurance policy against the kind of collapse historians have documented for centuries. By every conventional measure of wealth preservation, the stacker who has done this feels untouchable. That feeling deserves scrutiny. The modern silver stacking movement was built on a specific narrative, one repeated across countless channels, forums, and prepper communities. In this narrative, the financial system fails, paper currency becomes worthless overnight, and the person holding physical silver becomes the last functioning economy in the room. He trades ounces for eggs. He trades ounces for fuel. He becomes, in effect, the wealthiest man in a world that has forgotten what money even means. It is a compelling story. It is also incomplete. Markets, even broken ones, do not operate on cinematic logic. They operate on infrastructure, and infrastructure is precisely what this narrative quietly assumes away. The ability to convert an asset into spendable value depends on more than owning that asset. It depends on the existence of a functioning mechanism to verify it, price it, and exchange it for something else of equal worth. That mechanism is liquidity, and liquidity is not guaranteed by weight. It is not guaranteed by purity. It is not even guaranteed by scarcity. This is the tension sitting at the center of the modern stacking strategy, and it is rarely discussed with the seriousness it deserves. Accumulation has become the singular goal for many investors in this space. Buy more. Store more, diversify into more bars, more coins, more vaults. Very little attention is paid to the opposite half of the equation: what happens the day that stack actually needs to be spent, not held. This is not an argument against physical silver. History has proven, repeatedly and decisively, that hard assets outlast paper currency over the long arc of monetary cycles. That case remains as strong today as it has ever been. But there is a meaningful difference between an asset that preserves wealth over decades and an asset that can be converted into groceries, fuel, or rent within days, during precisely the kind of crisis it was purchased to survive. A stack that cannot move when it is needed most is not financial freedom. It is potential energy with no release mechanism, a fortress with no working gate. Before this analysis goes further, that distinction has to be understood clearly, because everything that follows depends on it. The question is no longer whether silver holds value. The question is whether that value can actually be reached in time. To understand why a silver stack can freeze at the exact moment it is needed, it helps to look at what actually happened during the recent spike toward $121 an ounce. Prices moved fast. Headlines called it historic. But beneath the surface, something less discussed was unfolding. The physical market for silver did not move nearly as smoothly as the spot price suggested. This is the first mechanic every stacker needs to understand. A systemic shock does not simply raise the price of silver, it disrupts the infrastructure required to trade it. Liquidity dries up quickly, and it dries up first at the local level, where most physical transactions would actually need to happen. Consider the practical problem of denomination. A large kilo-sized bar looks impressive in a vault, but it is nearly useless in a real transaction. No local business can make change for it. No individual buyer has the cash reserves to absorb it. The value is real, but it is trapped in a form too large to move. Even 1-ounce coins, the most liquid and recognized form of physical silver in the world, carry friction that did not exist a year earlier. At current spot-driven prices, a single coin represents a meaningful sum, and meaningful sums invite hesitation. That hesitation compounds with the second mechanic: verification friction. In calm markets, buyers trust what they are handed. In high-stress markets, that trust erodes fast. Counterfeit fears spike precisely when scarcity and desperation are highest, and rightly so. A poured bar without clear markings, a coin without an easily verifiable strike, these become liabilities rather than assets in the eyes of a nervous buyer. Tools exist to solve this problem quickly, from acoustic testing methods to diamagnetic slide tests. But these tools are rarely in the hands of the people who need them most. At the moment, they need them most. The result is a strange and uncomfortable paradox. Silver retains its intrinsic value throughout a crisis. What collapses is not the metal itself, but the local economy's capacity to appraise it, verify it, and price it with any confidence. A stacker, holding real, unquestionable wealth, can still find himself unable to convert that wealth into anything usable, simply because the surrounding infrastructure has not kept pace with the crisis unfolding around it. This is the uncomfortable truth sitting underneath every dramatic price spike this community celebrates. A higher spot price does not automatically mean easier access to that value. In many cases, it means the opposite. As prices climb and headlines spread, the very mechanics required to actually spend that silver become more strained, not less, leaving stackers holding an asset that is simultaneously more valuable and harder to use than it was the day before. If verification friction is the first wall a stacker hits during a crisis, the second wall comes from an unexpected direction: the very dealers he has relied on to buy and sell for years. It is easy to assume that local coin shops and bullion dealers exist as a permanent, stable bridge between physical metal and spendable cash. That assumption does not survive contact with a real panic. Dealers are businesses. They operate on finite capital, and their entire model depends on maintaining enough cash reserves to keep buying inventory while still meeting operating costs. During a genuine liquidity event, that model comes under immediate stress. As sellers rush in faster than buyers, dealers face a choice: absorb risk they cannot sustain or protect their own solvency. Nearly every dealer chooses the second option. This played out visibly during the recent run to an all-time high. Even as headlines celebrated record spot prices, dealers were not paying anywhere close to spot for standard bullion coins. Margins widened sharply. Some dealers slowed their buying altogether. Constitutional silver, historically one of the most liquid and recognizable forms of physical metal, saw its premiums compress even further, to the point where sellers were effectively subsidizing the transaction just to convert their holdings into cash. This is the paradox worth sitting with. The moment silver becomes most newsworthy, most exciting, most validating for long-term stackers, is often the exact moment it becomes hardest to sell at a fair price. Rising spot prices do not translate directly into rising liquidity. In many cases, they signal the opposite. As dealers widen their spreads specifically because uncertainty and volume risk have increased. This is also why cash retains a dominant, if uncomfortable, role in this conversation. The dollar is declining in purchasing power over time. That decline is well documented and unlikely to reverse. But decline is not the same as collapse, and the distinction matters enormously in a liquidity crisis. The dollar remains the medium recognized in the overwhelming majority of global transactions, which means it remains the bridge asset most sellers will ultimately need, even stackers who hold silver specifically to escape currency exposure. None of this diminishes silver's long-term case. Across the full sweep of monetary history, hard assets have consistently outperformed paper currency as a store of value. That case remains intact, and if anything, strengthens during periods of currency debasement. But the long-term case for holding silver and the short-term reality of selling silver during a crisis are two entirely different problems, and conflating them is where many stackers get into trouble. Understanding dealer behavior under stress is not a reason to distrust the physical silver market. It is a reason to plan around its actual behavior, rather than its idealized version. A stacker who understands that dealers pull back precisely when he needs them most is a stacker who can build a strategy around that reality instead of being surprised by it when it counts. Beyond the local dealer bottleneck sits a larger, quieter dynamic that most retail stackers never fully see. The institutional side of the silver market operates by an entirely different set of rules, and those rules do not favor the individual holding coins in a home safe. Over half of global silver demand comes from industrial use, spanning photovoltaics, electronics, medical technology, and defense manufacturing. When industrial shortages worsen, the instinctive assumption in this community is that scarcity benefits the retail stacker. In practice, it often does the opposite. Strategic industrial buyers do not compete for silver in the same marketplace as retail coin buyers. They secure supply through futures contracts, direct offtake agreements, and long-term arrangements with miners and refiners, locking in physical delivery at the wholesale level long before that metal ever reaches a retail counter. This creates a quiet but consequential decoupling. The price quoted on the futures exchange increasingly reflects paper positioning rather than the price an industrial buyer is actually willing to pay off-market for guaranteed physical supply. Retail holders are left participating in a parallel market, one that is far less liquid and far more exposed to sentiment swings than the institutional market operating just out of view. Layered on top of this is a second, more uncomfortable risk category. What happens to private metal holdings when a government finds itself cornered by a currency crisis? History offers a clear precedent in the 1933 gold confiscation under Executive Order 6102, but modern control rarely needs to look that direct. It tends to arrive through regulatory friction instead. Several mechanisms deserve attention here. Falling reporting thresholds on cash and precious metal transactions increase the visibility of private wealth to regulators. Capital gains treatment that classifies physical metal as a collectible rather than a standard investment can consume 30 to 40% of real purchasing power the moment that metal is sold. And perhaps most significant for a generation that holds metal specifically to stay outside the digital banking system, the potential introduction of a central bank digital currency as the primary off-ramp for converting metal into everyday spendable value would reintroduce exactly the kind of monitored on-grid gateway that physical silver was meant to avoid in the first place. None of these risks are hypothetical scare tactics. They are structural features already present in varying degrees across different jurisdictions, and they tend to intensify, not soften, during periods of currency stress. A government under pressure to stabilize its currency has historically shown a willingness to treat private hard asset holdings as a resource to be managed, not simply left alone. This is the part of the equation most stacking content skips entirely because it complicates the simple story. Physical silver protects against currency debasement, that much remains true, but it does not automatically protect against a state that changes the rules for accessing that value, and understanding that distinction is essential before addressing what a smarter strategy actually looks like. Everything examined so far leads to a single, unavoidable conclusion. Physical silver preserves wealth, but weight alone does not guarantee access to that wealth when it matters most. The solution is not abandoning the stack. It is restructuring it around a simple principle that too much of this community overlooks, a strategy built for liquidity, not just accumulation. The first adjustment is denomination. Large bars serve a purpose as a long-term store of value, and there is nothing wrong with holding some. But a stack weighted too heavily toward large bars is a stack that struggles to transact in a real crisis. Shifting a portion of that weight into smaller, widely recognized forms, particularly sovereign minted coins or constitutional silver, creates the flexibility to make small transactions without needing to break down an asset that was never designed to be broken down. Diversity of denomination is not a compromise on the thesis. It is the thesis, applied correctly. The second adjustment is storage. Concentrating an entire stack in a single location, under a single jurisdiction, introduces risk that has nothing to do with the price of silver itself. Distributing holdings across multiple secure locations, and to where appropriate, multiple jurisdictions, reduces exposure to any single point of regulatory or physical failure. This is not about complexity for its own sake. It is about ensuring that access to wealth does not depend entirely on one set of circumstances remaining favorable. The third adjustment is maintaining a genuine cash buffer. This is often the hardest advice for a committed stacker to accept, because cash is the very asset silver was purchased to hedge against. But a cash reserve serves a different function entirely. It exists to prevent forced silver sales at steep discounts during the exact moments when dealers have widened their margins and buyers have pulled back. Selling silver from a position of patience rather than desperation preserves far more purchasing power than selling into a panic ever will. The fourth adjustment is pairing physical holdings with assets that generate real yield. Silver produces no income while it sits in a vault. That is not a flaw, it is simply the nature of the asset. But an investor who holds physical metal exclusively, with no income-generating component in the broader portfolio, is fully exposed to inflation with no offsetting cash flow. Miners, select futures exposure, and precious metals-linked income vehicles can fill that gap without requiring a stacker to give up a single ounce of the core physical position. None of this diminishes the case for silver. The long-term argument remains as strong as it has ever been. But true financial security was never about how much weight sits in a vault. It is about whether that weight can move, adapt, and convert into real value the moment it is actually needed. A stack that stays locked in place is not protection. A stack built to stay liquid is.